Hey folks, welcome. We are live streaming with a great friend, a friend who was nice enough to take me out skiing with him last year about this time, JC Parets. JC, I wish we were out skiing right now. I'm sure I'd be feeling a lot better about things, but I imagine you're doing pretty well in just about any market, JC.
Yeah, you and me both, John. To be out on the slopes chasing you around in between trees. What I would give for that.
It wouldn't be bad. Man, I wish we were. Because last year, folks, JC and I were out there. We were enjoying some nice powder out in Breckenridge and up in not Copper Mountain, but Cooper. We were going skiing with a whole bunch of crazy market fanatics.
Yep.
And you had nailed a lot of things that were happening in the market at that time, JC. I'm not just saying that because you were nice enough to bring me out there, but literally time and time again, stock and sector over and over again, you were identifying setups and saying, here's why it's going higher, or here's why this one's rolling over. And people love that because especially right now, people want somebody to hold their hand at least a little bit, JC. I know I do. I want somebody to hold my hand. And if you think there's just coffee in this mug, no, not anymore. Not with this kind of market, JC.
Oh, I know you Chicago types. You know, I've had a drink or two at Ceres, so I know how you guys roll. Listen, and I appreciate the kind words. Let's go back to that time. Let's go back to March of last year. It was Chart Summit. We had a blast, a lot of charts, a lot of good skiing. But remember what was going on at the time. We were coming off that 2018 fourth quarter collapse, right? When bonds exploded. And we were really at the beginning of like a year-long rally or a little bit more than that. But what we were seeing was expansion in breadth. We were seeing improvement. We were seeing the list of stocks making new 21-day highs, new 63-day highs, expanding, right? Seeing more countries around the world making new highs, more sectors in the US making new highs. That was what was happening. So there was no reason to be bearish a year ago or 7 months ago or, you know, going into the fourth quarter last year. To the contrary, buy everything. A lot of things were working really well. New sectors were breaking out. Small caps you're coming back, right? Even transports. But we started to see that market deterioration in the second half of January. The market peaked on January the 16th, which I think gets lost in this whole thing. You know, I mean, I don't really follow the media, but from what I hear from my friends, everybody seems to be like, all caught off guard, like this came out of nowhere. But the truth is, John, I mean, I've studied a lot of market crashes in the past, you know, all of them really, and I've studied bear markets. I can't think of a time in the past where there were more warning signs than this time. And I say that, you know, so humbly, but there were so many divergences. Small caps were already rolling over, mid caps, micro caps, transports never made new highs. The value line geometric index, which is more of the median stock, it was already rolling over. John, regional banks peaked in mid-December. So, you know, there was plenty of selling and expansion in distribution and participation to the downside well before the S&P and the Dow ultimately peaked in the second half of February, and certainly before volatility really exploded. So there was plenty of warning signs and plenty of time to get out. So great, JC. Now what, right? Is the big thing. Well, we want to look for the opposite, right? What we were seeing was breadth deterioration in January going into February. What do we want to see now? We want to see breadth improvement. We want to see fewer stocks making new 52-week lows, not more stocks. We want to see fewer sectors making new lows, not more sectors, right? We're looking for breadth improvement. We're looking for positive momentum divergences. We haven't seen any of it.
Well, let me ask you this then, JC. I know we could go through a whole bunch of different stocks and look at fundamentals and say, look, some of these are getting down under replacement costs. Now, then there's a bunch of other ones like...
tell that to the machines.
Yeah, tell that to the machines is right.
Machines don't give a damn about your PE ratios or, you know, your sum of the parts analysis. You think that margin clerk cares at all that you're buying value or you're buying quality, they don't care. That thing's getting sold for you whether you like it or not.
That's right. Listen to JC, folks, because he's telling you the truth. Indiscriminate selling, like what we're seeing right now, is a sign that the leveraged folks are being carried out. Now, that's a sad thing. I'm not applauding it for whomever is unlucky enough to be part of that group being carried out. But I'm saying that's just, it's lifeboat ethic at this point. For those of you who aren't familiar, lifeboat ethic is, okay, who's going to stay in the lifeboat because they can survive, and who's going to be outside the lifeboat, meaning they're probably not going to survive. And they're picking, some of the strongest to stay in the lifeboat. And sadly, a lot of these others are being pushed out of the lifeboat. And one of those stocks that I'd love your opinion on, JC, is Boeing. Because this morning, of course, we heard that they said between themselves, Boeing that is, which is, of course, defense contractor, space, as well as aircraft, commercial aviation and so forth. They're saying that between them and their suppliers, they need 50 billion, maybe 60 billion to keep running through this. And this is a stock, JC, that has absolutely been slaughtered. It was down 45% last week, and today broke 100. And now it looks like, that it hasn't been able to find any footing at all, even as it just melts down. It's 93.40 or thereabouts right now. Take a look at that chart. I know fundamentals are a different story. We could say, well, the real value of the stock is negative X. Tell me what you think of the chart right here, JC, because this is one for the ages.
John, last night we had our conference call with our clients from all over the world. Everybody wondering, where's the support? Where's the support? Here's the thing. In low volatile uptrending environments, potential levels of support, potential levels of resistance, I should say, overwhelming amount of supply relative to demand, that there's a higher likelihood for that to come into play at logical levels, former levels of resistance, some of the measured move levels, former support levels. All of those potential resistance levels in low volatility uptrends tend to turn into resistance. We see that time and time again. On the flip side, potential support levels in high volatile downtrends don't give a damn what you think should be support. And the reason for that is because there is such a high amount of volume that it easily absorbs any demand that could have potentially been there, or even if you're right, actually was there. So we have to understand we're in two completely different types of market environments. So I could have mentioned 100 different potential support levels in Boeing. Market doesn't care. Margin clerks don't care. I'm looking at a chart. If you guys can zoom out, we're going back to the lows from the mid 70s in Boeing. We've already broken every potential support level. So, this is in absolute free fall as far as I'm concerned, especially if we're below 100, because remember, John, those were the 2007 highs. So if we couldn't hold those 2007 highs, to say that we don't have another 70% of downside left in Boeing, I think is irresponsible. We can get down to those 09 lows. Why not? Energy's below those 09 lows already. So who's to say that the airline makers don't follow along? There's nothing suggesting that isn't possible, number one. Number two, the selling we're seeing, John, Boeing aside, but the selling we're seeing seems very orderly. Very orderly. Doesn't look like panic to me. Doesn't look like a bottom. What do you think about that?
Well, when I'm seeing, like, for instance, JC, let me put this one up just because I'll share this from my screen. Let's see. I think I can share it. There we go. I'm looking here, JC, at that's a Boeing 5-day graph. And look at all these gaps in here. It's just crazy. There's no continuity whatsoever. March 12th, we, finish on those lows. We gap up the 13th. We more or less trade sideways. And look at the levels we were at back then too. Those levels, JC, look at this, 164, 171. We end up closing the day at like 170 or thereabouts. Then we open this week and just get slammed. We open down at 147, just keep trading down until the close. The only thing that stopped it was the close, and closed at 129. And then look at the 17th. Yesterday, it sat there, it rallied from a low print of right around 100, call it 101, all the way up in here to 124. One of our guys, not me folks, but one of our guys bought a bunch of Boeing down there at about 102, 103, and was lucky enough, God bless him, to sell it. Again, this is not me. This is not John saying, oh, I caught it down there at 102 and I sold it at 122. But this guy took 20 bucks out of that trade. Now look at it. The thing's cratered all the way down here to $90.59 just minutes ago anyway. 90.59, it's down 27% today, JC. So I gotta think somebody comes in with something in here for these guys. I don't know what though, JC. I don't know what it will take. I mean, for a while, I made this thesis last week, JC. I thought Buffett might come in here and say, you know what? I'm giving you another $10 billion. Not that he's given them any money so far, but I'm giving you $10 billion under these terms. I want, whatever, 10%, 12% dividend, perpetual. I want warrants for another, $10 billion worth of stock. I mean, anything to have people think that, an investor like him had put a commitment into a stock. But I don't know who's going to do that right now. Maybe it's Warren Buffett. Maybe it's nobody. Maybe this thing has to trade down, like you say, a lot further. But there's one of your graphs, I think, JC. Look at that damn thing.
Yep. So this is as of yesterday's close, John. And, what I'm looking at, between that 75 and 80 level, we need to look for logical areas. But as you can see here in the chart, every potential logical area has not turned into support. But if you're looking for what's next, I'm looking at about 75 to 80 bucks. That doesn't hold. You're looking at 30 bucks. And folks, I hate to scare you, but that's what we're talking about here. We're looking at another, stop sharing. All right. So what I'm looking at, John, is you're talking about the perpetual preferred that Buffett did with Goldman Sachs back in 08, 09, right?
Yes,
basically like a special deal that you're not getting, I'm not getting, mom and pop aren't getting that, only Uncle Warren's going to get to see that deal. But that's what you're looking for potentially.
Yeah, that's the sort of thing I think it takes, JC, to get some of these just throw the baby out with the bathwater conditions at least mitigated to a certain extent. Because I would have thought that we would have seen something like that already. But as you say, even though it's a dramatic drop in price, it has seemed somewhat orderly, even with these crazy gaps. And the volatilities that we're seeing here, are just crazy as well. It's going to be really hard, the damage that's done. And JC, since this one is, since Boeing is part of the Dow, it is just an incredible weight because you've got a Dow stock down 27%. And it's had multiple double-digit drop, percentages over the past 2 weeks. Some of them have been in the 20% and up range, and that's just brutal to any index. But unfortunately, unlike the S&P 500, which is cap-weighted, the Dow Jones Industrials is not cap-weighted, and so it's even more exaggerated in this index.
Yeah, there's no doubt about it. Let me ask you this. You know much more about the volatility index than I do, certainly. So let me defer to you. I mean, VIX over 100 seems like a virtual certainty at this point, doesn't it?
It seems like we're going to see that. I don't really know what would stop us, JC, from seeing that. Let me just hit this real quick. it's getting into the silly times here, quite frankly. And I think that's something that I guess we should expect. But sadly, it's something that is here right now. The very, very silly times, because some of these stocks, Boeing might be one of them, have no institutional support right now. Normally, JC, we look at something that has, 60+% institutional ownership and so forth, and we might say, well, these guys are the strong hands, right? These guys are going to hold this thing no matter. Obviously not. Obviously, quite frankly, given the volumes we're seeing right here, JC, I'm thinking that a lot of these kinds of stocks, like Boeing, I'm going to go pull up something on Boeing real quick, JC, but the average turnover in Boeing coming into this craziness was about 7 million shares per day. Then we ramped that up because of these drops. We ramped it up to 10 million. Today, we're already through 44 million shares. I mean, so you're seeing wholesale just, yours. When your hands are out like that, folks, you're a seller. When my hands are towards my face, I'm a buyer. So all we're seeing is hands out.
And you can see it in the charts, John. That's essentially my point, right? What you're saying is there's so much more volume than we've seen that all of that selling isn't able to be absorbed by the quote unquote demand that you think might be support, right? All of that selling, just like, a knife cutting through melted butter. I mean, that's really what it is.
Well, right now, folks, we are pumping up to a high reading so far today of just above where we are now for the VIX. I mean, we're over 85 for the VIX. That's the spot. Let me take a look, JC, real quick, since you asked about vol. Give me one sec.
Are you guys able to see that? Are you able to see that chart, John?
On yours? Let me see. Yep, I see it.
So this is really, I want to show the folks at home essentially what I'm talking about. This was the low, this was the bottom in 2008, 2009. And notice how when the S&P 500 finally bottomed in March of 09, the real bottom of the market was in October of 2008. I think that was either Lehman or AIG, one of those. But that was really the day that the most amount of stocks on the New York Stock Exchange hit new 52-week lows. That was the bottom as far as the internals are concerned. Because, John, when you go to the doctor, because you don't feel well, he's not going to look at you, hey, John, nice suit. It must be your kidneys. No, he's got to look inside of you and see what's wrong with you. You take your car to the auto mechanic. He's not just going to look at it and be like, hey, nice Mercedes, must be the transmission. No, he's got to open the hood and see what's going on inside. And as far as the market is concerned, it's the same thing, right? It's a market of stocks. So notice how here at the 09 bottom, it was a process, right? Where by the time the indexes bottom, most stocks had already put in their lows months prior. We could see the same thing here in 2016. We had new lows after that 2015 bear market, new lows into January, and then we got a rally, and then new lows into February. But on those February lows in the S&P, the Dow, and the NASDAQ, we had fewer stocks making new lows. In other words, most stocks had already bottomed in January of that year. Emerging markets, Latin America, they all bottomed in January as well. Here we're looking at the percentage of stocks that are getting oversold. So in other words, showing bearish momentum characteristics. We are currently seeing an expansion of that, not a deterioration. So look here at the 2016 bottom, for example. By the time we actually got the final low into February, only a fraction of stocks were showing bearish momentum characteristics. In other words, we were already seeing improvement of breadth. And today, we're just not seeing it. We're seeing an expansion of new 52-week lows. We're seeing an expansion of stocks entering a bearish momentum regime. So until that changes, John, the path of least resistance in stocks is down. And I think the path of least resistance in volatility is up until that changes.
Well, as you say, we have pushed up to and through 85 as far as the VIX. Now, the futures, let me see, where were those futures? I'm just going to rattle them off to you, JC. The futures were 74, 62, and 53. Those are the first three that are on my charts right now. Those are the heaviest volume. The first one the VXJOs, those are 75 right now. The next future out is 45,000 contracts, and it's trading at 62. And the next VIX future has traded 21,000 contracts, and it's trading 53. I mean, at these levels, JC, you're seeing just, obviously a pretty significant panic with people, putting these things into backwardation pretty hard. I mean, we're 21 points or more over the spot versus those the second future out there on the chart, and that's pretty ugly. That's usually about as bad as it gets, JC. But I'm not discounting what you said as far as these can go a lot further until we finally do see a turn. Let me show you
a trick. Let me show you a trick on what we're doing and what we've done in the past, and I'll show you some examples of the past. So for us, we don't know whether that was it or how much worse it's going to get. I mean, my bet is that it's going to get worse, right, before it gets better. But I'm not smart enough to be able to pick the bottom, right? I'm never going to do that. But I would rather pay more knowing that we're on the way back up. And let me tell you how we try to do that. What we look at is the percentage of stocks that are trading above their 200-day simple moving average. And you probably heard this before, and a lot of people like to talk about it when stocks are in uptrends. But I never really found it very helpful, this particular statistic, when stocks are in uptrends. The real value is when stocks are in downtrends to point to the turn having already been seen. So we're not interested in when the percentage of stocks above their 200-day falls below 20% or 15% or 10 or 5 or single digits where it is now. When we want to buy is when that percentage returns and gets back above 20%, even 15% if you want to be more aggressive. So let me rewind to December of 2018. I actually just snapped this from a presentation that I gave at the time, so that's why it's a little blurry, but just bear with me here. It's not when the percentage of stocks above their 200-day moving average falls below 15%. The time to buy is when we get back above it. So as you can see here in December of 2018, that's exactly what we were saying. Hey, wait till we get back above. We're not even below it yet. So what happened? Well, we got under it into the low teens. And then when we got back above it, coming into January, it was a perfect time to buy. Sure, did we pay more in January after getting that confirmation than we would have trying to guess the bottom a week earlier? Sure, but it was still a great entry point. Today, we are below 15%. So now that it's triggered, right? The potential signal is now triggered. Now we are waiting for the entry point. So now we have the heads up. Now we're waiting for the entry point when we get back above 15%, or if you want to be more conservative, 20% of stocks on the New York Stock Exchange above their 200-day moving average. That's when we want to buy, because I think that it's prudent to know for a fact that it's going to be impossible for you to pick that bottom. So why try?
Yeah, well, it's great advice, JC, because you know what they say about people that pick bottoms, they have stinky fingers. And this is definitely one of those situations here. Volumes, by the way, today, folks, are not at the sorts of levels that I expected to see. Just to give you an idea, right now we're coming up on what? 1:57 East Coast time, so coming up on 2 o'clock East Coast time, so 2 hours to trade. We're up to 22 million contracts on the options. That's more than normal when normal was January, but that's not putting us on track to be up in the 40 million contract levels that we saw just a week ago. We were seeing 42 million contracts and 39 million contracts, JC, in the options. And I'm taking all of the options. I'm not just saying this is VIX, this is Apple, this is these, but to give you guys an idea of where we're seeing the biggest volumes again today, of course it's equity funds like Spider and so forth, indexes, internet. So what are we counting in internet? Let me give you a quick one on that. we're counting Uber, Amazon, Facebook, Roku, Baba. Those are some of the biggest volume ones. And oh my gosh, JC, if you wouldn't mind, again, this is new territory. Uber has not been here. And I thought you had an opportunity last week at 19, and I traded it for a trade. But then it just burned through that to the downside. And now Uber's trading with a 14 handle right now as we speak, JC. So would you mind taking a look at that chart just for a sec? Because UBER, again, plumbing to levels, I think people are thinking this thing's like WeWork or something.
Yeah, let me share the screen. So here's what I'm seeing. So we could take these extension levels, right? You ever see that chart, John?
Yep, I see it.
So we could take these extension levels from these lows here up to these highs, right? And then here's your divergence, right? So with new highs, excuse me, with new highs in the index, we had lower highs in momentum, right? That's classic bearish divergence, right? With these new highs. But we're down to 15 or so and change, right?
Yeah.
So this is potential support, right? We take the low to the high. The 161.8% extension is going to take you right around 5.25, 5.5. If we're not above that, we cannot own it. But this goes back to what I was saying before, that momentum is getting oversold. It's confirming what we're seeing in price. Breadth statistics are confirming what we're seeing in price. We are not seeing those divergences. So again, I think it makes the most sense, rather than trying to be a hero and bottom fish and pick the bottom, I think it makes a lot more sense to let it bottom and pay more knowing it's on the way up. I mean, I cannot emphasize that enough, John. But if you must be long, make sure to only do it if we're above 15.5. How's that?
All right. Wow. Because that's, you know, that's as ugly as a chart as I've seen in a long time. That's uglier even perhaps than Boeing. I mean, and that's tough to do, but because
it found a way.
Yeah. Wow. And for a whole bunch of reasons, folks, we know Uber delivers food and so forth, but with people hunkered down and not going out, the volume of folks using Uber right now has to just be not just historically low, it has to be at the lowest use percentage that they've ever seen for this company. And it doesn't matter about Uber Eats. You see a Grubhub, for instance, is a slightly different story, of course, because they're not dependent. The bulk of their business isn't people driving around with the driver. But clearly Uber, you know, that is the bulk of their business, especially on the revenue side, and that has dried up. So delivering you your McDonald's for a little spiff, a couple bucks here and there isn't going to cut it for Uber. So oof.
Yeah. So John, listen, I got to hop because the market's crashing, but I'm gonna leave you with one last thought.
One last thought.
It's a joke that is certainly not as funny as maybe it once was. So a technical analyst and a fundamental analyst are chatting about the markets in the kitchen, right? Yes, accidentally, one of them knocks the kitchen knife off the table, landing right on the fundamental analyst's foot. So the fundamental analyst yells at the technician, asking him why he didn't catch the knife. He said, "You know technicians don't catch falling knives," the technician responded. Then he in turn asked the fundamental analyst why he didn't move his foot out of the way. And the fundamental analyst responds, "I didn't think it could go that low."
JC, thank you, my friend.
Anytime,
Folks,
John.
That's JC Parets. JC is a proud graduate from the U down there in Florida, Miami, right?
I grew up a Miami Hurricanes fan. My fastball wasn't hard enough to play at the University of Miami, unfortunately, or fortunately, as it turned out for me. But I did pitch for Fairfield University. Never got a chance to make it to the College World Series. Never even made it to the regionals.
Well, JC, it's a pleasure. Thank you very much. Folks, you can see more about JC's work over at All Star Charts. If you follow him on Twitter, it's just at All Star Charts. And again, thank you for your time, JC.
You got it, John. Thanks for having me. See you later. Good luck out there.
Good luck, folks. We'll be putting up another little bit on what's going on in the markets. Our 3 for 3 unusual activity coming your way in about an hour. Thank you.